Since the beginning of this year, China has implemented a wide range of economic stimulus policies, including tax cuts, increased money supply, and expanded government spending. However, so far, these measures have had little impact. After decades of rapid economic growth, China is now facing the reality of slowing growth, and may even face the prospect of negative growth. More critically, the issues and contradictions that have accumulated over the past few decades are likely to erupt in the next 5 to 10 years. In this piece, I will outline 5 of the most critical challenges facing China's economy. First, the collapse of the real estate market has directly weakened Chinese consumers' purchasing power. In China, the consumption of major household goods is closely linked to real estate sales. Take Gree Electric, China's largest air conditioning manufacturer, as an example. In the first half of this year, the cash revenue from its product sales dropped by 31.6% year-on-year. This figure indicates a sharp decline in Chinese consumers' spending on air conditioners. A related statistic is that the sales area of new homes, or first-hand properties, fell by 40% in the same period. China, with a population of 1.4 billion, has about 150 million people living in a dozen large cities spread across the eastern and central regions of the country. These residents form the core of China's middle class. In these major cities, the per capita GDP is around $20,000, similar to the levels of European countries like the Czech Republic, Spain, or Greece. Starting this year, China's middle class has stopped buying real estate, as well as major consumer goods like home appliances, renovations, and electric vehicles. They are also cutting back significantly on non-essential household spending. The contraction in domestic consumption is pushing nearly every industry in China into a state of overcapacity, with much of the industrial output struggling to find buyers. Second, the heavy debt burden of Chinese local governments is a significant issue, and many may already be functionally bankrupt. According to data, the total debt of China's local governments is around 91.1 trillion yuan, or about $13 trillion, which is roughly half of the US national debt in 2020. However, it's important to note that this figure doesn't include the debt of the central government. The structure of local government debt in China is also quite complex, divided into explicit and implicit debts. Implicit debt stands at 50.1 trillion yuan, while explicit debt is around 40 trillion yuan. Explicit debt is easier to understand, it's the public borrowing by local governments under their own name in the market. But implicit debt is much more dangerous. Local governments have set up numerous wholly state-owned companies, often called urban investment companies, in China. These companies typically have only one shareholder, the local government's finance bureau. Local governments borrow money through these companies, and the resulting debt forms the implicit debt, which is estimated to be around 50.1 trillion yuan as of 2023, or possibly even higher. You might be asking, why do these state-owned urban construction companies need to take on so much debt? For many years, local governments in China, similar to state and city governments in the US, have been responsible for investing in urban infrastructure, including building extensive road networks, utilities like water, electricity, and gas, stadiums, and high-standard industrial zones. These investments have fueled the rapid growth of industries like steel, cement, automobiles, and real estate over the past 2 decades. To finance these projects, local governments establish urban construction investment companies, which borrow from the capital markets and then invest in fixed assets. It's important to note that in China, land is state-owned, not private property. Local governments have control over land resources, and state-owned urban construction companies generate revenue by selling land. They also use land as collateral for their debt. However, if the real estate market collapses, land sales would dry up, leaving these urban investment companies unable to repay their debts. This would prevent local governments from continuing their expansionary investments, leading to clear signs of economic collapse in China. Third, foreign companies are beginning to pull out of China and are reducing their dollar investments in the country. Many foreign firms that once invested in China have begun pulling out in recent years. I've compiled some examples. Over the past 3 years, several global tech giants such as Micron, HP, Qualcomm, Microsoft, and IBM have scaled back their operations in China. Most recently, on August 26 of this year, IBM laid off over 1,000 Chinese employees in just 3 minutes and shut down both its China Systems Center and China Development Center. In addition to withdrawing existing business, Western countries are also cutting back on their dollar investments in China. Data from China's Ministry of Commerce shows that in the first half of this year, actual foreign investment in China fell by 29.1% year-on-year. It's important to note that this decline would be less significant if measured in US dollars. I believe the fundamental reason why major economies like the US, Europe, and Japan are losing confidence in China's economy boils down to complex geopolitical risks. This leads me to the fourth critical issue affecting China's economy, one that impacts not just foreign investment but also Chinese citizens themselves. Fourth, rising international geopolitical risks are driving up China's household savings rate. There are multiple potential flashpoints for conflict in China's neighboring regions, such as the Taiwan Strait, the South China Sea, and the China-India border. War would severely hinder economic development and undermine the confidence of businesses and individuals in the future of the economy. Without confidence, economic growth inevitably slows, and economic activity loses its vitality. As a result, many Chinese citizens are increasing their savings substantially. In 2022, the household savings rate in China was 38%, and if we include savings in guaranteed government bonds, this rate is estimated to be around 45% this year. For comparison, countries like Japan and South Korea, which have cultural similarities to China, had household savings rates of about 16% in 1985 and 1995, respectively. Even compared to these high-saving East Asian nations, China's savings rate is remarkably high. Fifth, there is a lack of confidence in private investment within China. It's important to note that over the past 30 years, private capital in China has been eager to invest in emerging industries and startups. For example, the first round of funding for China's largest internet companies Alibaba, Tencent, Pinduoduo, JD.com, and Xiaomi largely came from Chinese private capital. However, since 2021, Chinese private investors have shown little interest in financing startups or investing in expanding business operations. Beyond these 5 points, the most significant variable for China's economic future is its population. One undeniable fact is that, as a country of 1.4 billion people, China now has one of the lowest birth rates in the world, second only to South Korea. Since 2017, the number of new births in China has been declining each year, and in 2023, only 9.02 million babies were born. This sustained and significant decline in new births will be the most pressing challenge for China's economy in the years to come.